here comes Binance, which in my opinion is the world's largest digital bank. Yeah, you may not want to call it a digital bank, but guys, that's how they operate. You are talking about an organization that is larger than most banks in the world. And now they've launched Sharia compliant product. Your guess is as good as mine. Hi everyone, this is Ali Hussein Kasim from Ali Talks Tech. In this week's weekly roundup of tech news across Africa and the world, I'm covering 5 interesting stories. The first one is on the Bank of Ghana's announcement late last week of the requirement for virtual assets firms to register. That's crypto for the unschooled. How is that gonna pan out? How is that gonna start affecting the ecosystem in Ghana? That would be something to think about. The next story I'll be covering is Tanzania's mandate of all incoming remittances to go through their central bank governed and owned TIPS. That is the Tanzanian instant payment system. What are the implications? How would that affect the wider Eastern Africa region? Very interesting conversations going on. My third story is on Binance's Sharia Earn product. That is the first major global crypto exchange to launch a Sharia product. Quite interesting. Then my fourth story I'll be covering is 2 stories in one, actually. Stitch and Efficacy. Stitch is one of the open finance, open API fintechs based in South Africa that has been on a tear in terms of growth and acquisitions. They've just acquired another fintech that is connected to the national payment system in South Africa. What does that mean? And as I speak to this story, I'll also speak to JP Morgan's announcement that they will be charging for access to data. So the question is, whose data? My last story is on another acquisition, this time in the crypto space. Roqqu, a crypto exchange based in Nigeria, is reportedly acquiring Flitaa, an exchange based in Kenya. Let me be honest. First time I've heard of Flitaa. That just goes to show you how dynamic and how interesting and revolving the whole fintech ecosystem is and continues to be across Africa. So let's speak to the Bank of Ghana's announcement of a mandatory registration requirement for all virtual asset service providers operating in Nigeria. So up to now, Ghana. Up to now, Ghana has sort of had a sort of legal lacuna when it comes to crypto. There's been no law, there's been no regulation, been really no policy to speak about. So we are seeing the first moves by the regulators and policymakers to start regulating this space. And it starts with registration. I like this point because you don't just wake up one morning and say, we're regulating you or we stop you from operating. The Bank of Ghana has taken an interesting and prudent move to first start registration. The crypto companies have up to 15th of August to register. And the implications, if you don't register by this time, chances are when the environment is ready for applications, for regulations and all that, you may just be out in the cold. This is an interesting one for me. The Bank of Ghana, to me, is becoming a blueprint of how regulation can and should be done across the African continent, especially when it comes to fintech. They are one of the very few, actually, I can't think of another one that specifically has a fintech and innovation department headed by a director level executive. This has the effect of showing clarity when it comes to policy and regulatory matters. And it also has the effect of saying this is the one-stop shop when it comes to regulation in the financial services and fintech ecosystem. And this is a good thing. So, ladies and gentlemen of the crypto world, if you're operating in Ghana, please start knocking on the doors of the BOG so that you can start having your registrations in place. Failure to which, I guess everything's going to be up in the air after August 15th. Now I want to move to Jirani, Tanzania, my neighbor. And Tanzania's Bank of Tanzania, the regulator, the central bank, has announced a groundbreaking policy requiring all incoming international remittances to be routed exclusively through the Tanzanian instant payment system starting August 1. So in about 2 weeks. This really marks a very significant shift in Africa's remittance landscape in terms of how policymakers and regulators deal with money transfer. Key points to note. First, this is a centralized routing perspective. No other country in Eastern Africa has one point where all remittances come into. What does this mean? Every cross-border payment must go through TIPS, each and every one of them. This has the effect of giving the Bank of Tanzania full transparency, stronger AML, that's anti-money laundering control, real-time settlements, and reduced informal flows. When we're talking about informal flows into a country, you have the formal flows where the central bank has a feel, which basically comes through regulated entities, whether it's fintechs or financial services, players or SACCOs or whatever. They have a grasp of what's coming in. Unregulated inflows are the ones, send me some money. Somebody's coming in from the US and they have a bundle of notes in their pockets, or Hawala systems are still working. Those are informal money transfer operators, although slowly but surely those are being phased out because of all the anti-money laundering and terrorism financing going on across the world. The other key factor in this is a fixed fee structure regime. It's a flat interchange fee of 1,000 Tanzania shillings. That's around $0.38. Applies to all remittances. This is significant. This might significantly impact small value transactions or transfers. Now, what I did, I had conversations with my compatriots in Tanzania, and they told me, look, Ali, this is insignificant. Let's not make too much of a hula baloo around it. The money transfer costs from telcos are higher. So what are we talking about? The benefits clearly are that policy aims to increase transparency, compliance with financial transactions, and facilitate a systemic remittance data tracking. What are the trade-offs? While it's centralized control, it risks a potential raising costs for low value, although I did mention that that's sort of being mitigated by, in comparison to what is currently being charged. There will be a reduction in flexibility. There will be a reduction in redundancy. If the system is down, then basically what are we saying? Inflows stop. For me, one of the most interesting components around this is the possibility for open finance in this. This creates a situation where open finance can actually be encouraged by the policymakers and regulators. So let's look at the regional context. Tanzania's approach contrasts very sharply with Kenya's multi-system. A variable fee by pesa-link model, Uganda's mobile-centric model, which basically signals a no-size-fits-all reality when it comes to the Eastern African community. It will be interesting to see how this will play out as the Eastern African community starts to strategize on their centralized or regional payment ecosystem. So, the regional impact, Tanzania's inflows are around $747 million a year compared to Kenya's $4.8 billion. So this experiment could set a precedent for systemic remittance management or serve as a cautionary tale about over-centralization. The jury is still out, ladies and gentlemen. So how are we looking at going forward? We're all going to be watching how Tanzania executes this. My sense is that I'm cautiously optimistic that this is a move in the right direction, because I have always been a firm believer in payment fees being a race to zero. Now, let me speak to Binance's Sharia Earn product. This is quite an interesting conversation for me. Binance is the largest crypto exchange in the world with trillions of dollars of transactions every year. Now, they've stepped into the Sharia financial services business, offering non-interest, Sharia compliant, crypto structured investments. Super interesting. Let me give you some facts or statistics that we may not be aware of. Did you know that Africa's population is more than 50% African? Did you also know that 40% of those would want to access a Sharia compliant financial services product but are unable to because there is none around? Now, here comes Binance, which in my opinion is the world's largest digital bank. Yeah, you may not want to call it a digital bank, but guys, that's how they operate. Sending money, investments using crypto and stuff like that. So you are talking about an organization that is larger than most banks in the world, that has zero branches. Everything is done virtually. And now they've launched Sharia compliant product. Your guess is as good as mine how that is going to pan out. These are monsters when it comes to user experience, when it comes to how they serve their customers at scale. These guys have more than 100 million customers logging in onto their platform at any given time. So that level of distribution globally is unprecedented for any financial services product. Now, they've entered into the Sharia compliant financial services ecosystem. Let's keep this very close. We'll be watching this very, very closely as we move on. And yours truly will be one of those who will be trying this new product as soon as it's available in our markets. Now we come to Stitch, which is an interesting fintech based out of South Africa. Stitch has acquired Efficacy, another payment service provider of fintech based in Southern Africa. It gives Stitch direct clearing power with Efficacy. Efficacy holds what in South Africa is known as a designated clearing system participant, DCSP status in South Africa, which now gives Stitch the building blocks of a super interesting payment technology stack. This can do end-to-end acquiring. It is an integrated infrastructure. And we're starting to see Stitch broadening its product reach both locally and geographically. They are looking at a very interesting fragmented Southern African market. We will likely see them potentially entering Eastern Africa very soon. The race to payment rails in Africa is still extremely open. But the whole conversation around open finance is becoming increasingly sensitive, but also highly, highly attractive. You have many fintech players across the continent, but few can say they have unified rails. We are starting to see a few players that are coming in. Then there are those external rails, like correspondence banking that is offered by players like JP Morgan. And we are starting to see JP Morgan telling fintechs there's no free ride anymore. If you want access to our data, you have to pay for it. It belies the point, whose data is it? Is it the customer's data, or is it the bank's data, or is it the fintech's data? So you have customers in between, and then you have sort of fintechs who want to access these customers. You have banks on this other side saying, no, this is our data. These are our customers. So let me ask you guys, who owns you? And I know I've talked about this many times. Who owns you as a customer? Is it the bank? Is it the person? Or is it the organization that gives you value at that particular time that you need that value? This is an age-old question that will not be answered today, but will continue to be a conversation that we'll be having as we move on. My last story is a very interesting one. Roqqu Acquires Flitaa. This is a milestone for intra-Africa crypto exchanges. These are two African crypto exchanges, Flitaa in Kenya, Roqqu in Nigeria, who have come together. Now, story goes, these guys have not raised any VC money. This is all bootstrapped money. And they have now come together through a merger or an acquisition. Very, very interesting, because we are starting to see homegrown African players coming up and saying, you know what, guys? We will compete hand to hand with the Binances of this world. I will be watching this story very, very closely. Ladies and gentlemen, with that, I close this week's weekly roundup and looking forward to seeing you guys next week. Asante.